I'm Jessica Minton for IB Times TV, reporting from the floor of the New York Stock Exchange, and I'm joined again by Keith Bliss of Cuttone. Now, they ended up tapering. The Fed ended up tapering $10 billion equally on mortgage-backed securities and treasuries. What was the reaction on the floor to that news?
Well, there wasn't a lot of yelling and screaming, if that's what you're looking for. There was some chatter going on. The news down here gets disseminated pretty quickly and spread around, and you can see the reaction in clients trading and what they're doing. Certainly we got a spike in volatility off of that. The market traded down, the S&P traded down about 13 handles and then turned right around and was up another 13 handles, so quite a move in about 5 minutes. But there was, interesting reaction. I think people read a little too much into what $10 billion is actually going to do to the market. And then they started parsing apart the Fed statement. What they're really focused on are the rate guidance going forward and the short-term rates. I was just listening to Chairman Bernanke give part of his press conference, and he was saying that short-term rates are likely going to stay until 2015 at the earliest, when they'll think about raising those up. And then beyond that, Fed funds rate will likely stay around 1%, anchored around 1%. It's all data dependent, of course. If we get massive spikes in inflation, then they'll move that timetable up pretty substantially. But listen, short-term rates for another 2 years, or another year and a half, rather, is really a very strong statement about what their willingness to both support the economy, even in the face of what they anticipate higher inflation and higher growth rates than what we've experienced in the last 2 years. And the equity markets will cheer that type of statement out of the Fed. It means that the extraordinary stimulus will eventually be taken away, and the extraordinary stimulus meaning quantitative easing. But the traditional monetary stimulus, as long as they can get the transition mechanism back in place, will be there for quite some time, and that will support risk markets, especially equities.
Now, I've talked to you so many times about the Fed, when they're going to taper. I also talked to you after that big September meeting where a lot of people thought they were going to taper. Now, something you pointed out, you talked about the 10-year Treasury yield, about how that's the North Star, and how if it peaks above, stays above 3%, we'll definitely see some tapering. The yield was at 2.86%. So do you think that may have surprised some investors out there?
The market was interesting. I had this conversation with a client this morning where when you looked at equities and you also looked at bonds, in our work, in our quantitative work, a model that we look at quite heavily, both of them were slightly, moderately oversold, which meant that there were some bets out there that the Fed was going to taper and there was going to be that initial reaction, but not so much where you had this conviction that they were just going to take, $40 billion off the table. So people were clearly hedging their bets. I do think that the taper, even being modest, and $10 billion, I think it's a token gesture towards the improving labor economy in this world today. It's not going to do a whole heck of a lot to affect the markets. It's $10 billion. It's not a lot. And I think you saw the reaction from the 10-year yield. The 10-year yield was actually down a basis point before I walked over here. You would expect some sort of spike. 10-year yield is always a great indicator to look at. That's what I always encourage people to look at, because the bond, I've often said the bond guys are always smarter than the equity guys about forecasting what Fed moves are going to be and how the economy is going to play out. And that 10-year yield is always that great compass that we watch. I will tell you, though, I've discovered that probably the greatest indicator, and we all missed it. I heard it, but I missed it about a week ago, with St. Louis Fed President Bullard, where he gave the best indication in the world that they would throw a token taper announcement at the labor market to indicate that that's been improving. He was absolutely right. He was throwing us the best signal, and a lot of us missed it.
Now, this has most likely been Bernanke's last meeting as Fed chairman, since Janet Yellen, she still needs to be confirmed, but she's most likely is coming in January. Do you think that there is some sort of maybe legacy issue there, and they wanted to get this ball rolling right before he leaves?
Perhaps that's true, so that people wouldn't, so that a lot of people wouldn't write Chairman Bernanke as this Keynesian hiding in sheep's clothing, so to speak, which he's not. He's more of a moderate, monetarist guy. He understands the effects of both sides, both accommodative as well as restrictive monetary policy. So there may be something to that. I think, though, thinking about it, what's coming down the pike is that the FOMC will change complexion pretty dramatically for 2014 when Dallas Fed President Fisher and Philly Fed President Plosser comes on the board. They are extraordinarily hawkish on monetary policy. So I'm almost wondering if they decided to do something now just to kind of placate those guys when they come on and they start really pressing in January, because they will press in January. Fed President Fisher has basically said the program's not working anymore, just get rid of it altogether. So maybe this was more of a bone or a signal to those two that, hey, we've started into this, just lay off the hawkishness for a while. The economy's not ready to support your views, but we'll keep moving in the right direction. I think that's probably what it was more for.
We have seen the unemployment rate continue to come down further and further. Is this a sign that there was enough data out there for the Fed to say, hey, the economy is improving and now we can start tapering?
Yes, however, if you listen to Bernanke's comments, if you go back and read the statement, they're still very concerned about the labor market in the forms of the long-term unemployed, as well as the types of jobs that are being created. You've heard me say it to you many times, it's not the quantity, it's the quality. And while we're now generating on average, and I hope it continues this way and actually moves forward, about 200,000 jobs a month, there's still too many in the low wage category. You know, you get a lot of jobs created in the food and beverage industry, for example. Those are very transient jobs that tend not to pay a lot of money. That's not going to be the type of job and wage creation that we need in this country to really get the economy moving. We need more high-paying manufacturing and service sector jobs that are being created. That's one of the things that they're really battling against. I know it's been confounding to the chairman. That's one thing that's been different about this recovery from other recoveries. The recovery has been very asymmetric in that regard, meaning that the upper end of the wage earners in this country have benefited tremendously in what's happened inside of the risk asset markets, but yet the majority of the country is still struggling a little bit because we're only creating low wage paying jobs. That's got to really turn around a lot, I think, before they really decide to take their foot off the gas completely.
Now, you and I have talked so many times whenever any sort of economic data comes out, housing, GDP, jobs report, and there tends to be this thought of, is good news, bad news, because then they're going to taper. Do you think this is psychologically important for the marketplace for them to start tapering, because then the market doesn't necessarily need to be dependent on artificial stimulus?
Yes, I do. In fact, there were a lot of people out there, including some very well-noted global economists, that suggested that the Fed would never be able to stop tapering. So this is a good signal. I've thought for a long time that the efficacy of the program had reached its end. You look at indicators like velocity of money, which I've talked to you about many times, they're just not there. So why keep throwing money at a problem when it doesn't seem to be affording any kind of resolution? So I think it was a very good signal to the marketplace. The market will have to adjust and recalibrate how it trades based upon economic data. Good news should be good news. The one thing that we're going to really look for in 2014 is, can the equity market sustain these gains? And the only way they're going to be able to sustain the gains is that companies are going to have to show us top-line sales improvement as opposed to bottom-line revenue and EPS improvement. And that's going to be the real benchmark for 2014, I believe. But at the end of the day, the Fed needed to do this. It was good that they went ahead and started on this path. Hopefully they can kind of clear the decks for 2014, get out of the way. And then we'll focus on real economic data and rates and company sales and earnings and all the other things that we're accustomed to focus on. We just haven't for the last 2 years.
And finally, Ben Bernanke said at the beginning of his press conference, if there's more improvement, they will taper more. How long until you think they'll taper at a next meeting?
Interesting question. The beginning of the year is always interesting for economic data. You get a blast of it based upon the year end. We're going to be thinking about what the fourth quarter GDP, we're first going to get the final read on third quarter GDP before we hear anything about fourth quarter GDP. Companies will start coming out with their earnings very soon in January. We'll get a slew of company earnings before they meet again at the end of January. So, listen, it's certainly plausible that they could go ahead and take another modest chop out of the QE program. What the professionals are starting to focus on now, and I heard it very quickly after the announcement, is what is the rate guidance? What does the short-term rate picture look like? Chairman Bernanke said in his statement he's convinced that even at $75 billion a month, they can keep the long end of the curve pretty suppressed to continue that recovery in the housing market. If it hasn't recovered fully already, the numbers are pretty outstanding there. So listen, it's certainly plausible, and again, you have a change in the complexion of the FOMC. You've got more hawkish elements that actually have a vote, not just influence, they actually have a vote. So Chairman Bernanke in his last month, and then Chairwoman Yellen going forward. She's got a real interesting tussle on her hands with the new complexion of the FOMC. Certainly, if Fisher and Plosser have their way, you'll see the QE program in before the end of June. I don't think that's going to happen. Bernanke even said in his statements before I walked over here that it's more likely by the end of the year they'll be out of the way. But yeah, I think we'll see a continued pullback on the QE program, and I think the markets will like that.